Hi, and thanks for tuning in for another episode of Ask Spurrell CPA. Today we're talking about business loans. And I have Yahweh here with me again, and Yahweh knows very well about the trials and tribulation of getting business loans for clients. They all want loans, and they realize it's not easy sometimes.
Yeah.
So the quote we have here is Robert Kiyosaki, author of Rich Dad Poor Dad. Good debt is a powerful tool, but bad debt can kill you. The statistic we go back to time and time again, 50% of all Canadian small businesses will go out of business in 5 years. And one of the top 3 reasons for that is they'll run out of cash. So the story that we have is, business owners, they either can't qualify for a loan, they can't get the loan quick enough, or they can't pay the loan once they get it. Yahweh, what are the questions we think these business owners should be asking so they can be prepared?
Well, first, is it easier to finance operating capital or hard assets?
Yeah, so it is 100% easier to finance hard assets. There are more opportunities available to you. The banks are more agreeable to lending on a hard asset that they can secure. We also always have the Canada Small Business Financing Program that's available as well, which only goes towards hard assets. So it's, equipment and vehicles and leasehold improvements, real estate. It's not actually going to go to finance an advertising campaign or who finances that payroll. So it's infinitely easier to finance hard assets in Canada than it is operating capital, especially for a startup.
Is it easier to finance hard assets on the initial purchase or after acquisition?
Yeah, so that's the trap. It's easier to finance them on the initial purchase. Once you already have them on the books, there are some things that you can do, but your options are limited. So you really have to ask yourself, is there going to be any sort of cash crunch in this business at all? And then if there's going to be a cash crunch in this business, are there any hard assets that we're purchasing? Okay, so if there could be a potential cash crunch in this business, which most have that potential, and we are purchasing some hard assets, we should finance those hard assets first, because generally that's the point where, and here's the hard part, is lots of times you have cash at the beginning when you need to, you put some aside, you have some savings, you have some, personal credit that you can deploy or personal assets you can put into this thing. And you can go out and get started with that asset, but then later on you run out of cash for operating capital. So you got to make maximum use of your financing opportunities for those hard assets at the beginning if there's going to be a cash crunch, because with the realization that if you run out of cash later, you're going to need to preserve cash later for operating capital, because the opportunities to finance that are fewer and far between.
How does the processing time for business loans compare to personal loans?
Yeah, so a lot of business owners, they compare it to, I bought a house, and they might have bought a $500,000 house and they got the deal done in 2 weeks. Most realtors will tell you, hey, that's maybe look for a month, let's close in 30 days type of thing. The business loan that closes in 30 days is like the holy grail unicorn that never comes around that often. So I generally tell people it's 60 days. It's a longer approval process. Looking at someone's T4 and looking at their overall debt and trying to determine if they have the debt servicing ratio to purchase a house and apply for a mortgage, it's so much easier than looking into a business and all the different permutations and combinations that can happen with his business, or they're going to affect the cash flow of the business. And even the understanding of the business financials is sometimes a challenge going through the bank as well. So it's going to take longer. The deal is going to take longer than it will on the personal end.
Okay. Well, speaking of timelines, how can formal appraisals and environmental assessments affect these timelines?
Yeah, so let's say, I'm telling people 60 days is kind of that minimum threshold for the average business loan to get approved. But one of the conditions that might come from the bank is we need a formal appraisal from either a charter business valuator, or sometimes the banks have specific people on their list for specific types of industries, or they need an environmental assessment from a qualified individual who can provide that environmental assessment. You're building a building and they want to know that there's not a whole bunch of radon gas and this building is going to be useless and someone's going to walk away from this thing. So those formal appraisals, environmental assessments, those projects themselves, can take 30 days. And that's an efficient guy who's running through the project. So now we're talking about we had a 60-day timeline, and now all of a sudden it becomes 90 days, really quickly, because we have to do a formal appraisal, or we have to do an environmental assessment, which in itself is a project all into itself.
Well, can you get 100% financing for some purchases?
You can. There are the opportunities these days. Depending on the asset class. That there can be an opportunity for 100% financing. So some businesses might, sometimes they think, I can't go get that building, or I can't buy that existing business because there's no financing. But lots of times there's 100% financing. So it's something that you should be aware of, because sometimes the ability to acquire it is closer than might seem. There's some clients we've had, and they're locked into these rent agreements, and they're saying, well, I didn't have any money to put down on a space, and when we look at the industry that they're in, they could have acquired the space for zero down, so the mortgage payment would have been cheaper than the rent right from day one. Sometimes that's the scenario that we look at. So for all the difficulties with operating capital, it's not that there is no opportunities for operating capital, but it's harder. But sometimes for those hard assets or initial purchases, sometimes it's not only available, but 100% and at good terms.
Why is the amortization period often more important than the interest rate? Yeah,
so we're looking at a business that potentially might have some cash flow considerations. That's why they're financing this to begin with, and then we look at do they want a business loan that's at 4% or 4.5% or even 5%, let's say, but then we look at one loan is going to be paid back over 10 years. And the other loan at 5% is going to be paid back over 20 years. One of them, if you have 20 years to pay it back, even though it's a 1% more, that can be the difference between running out of cash or not, is having long enough to actually pay back that loan. And we'll see a lot of these, especially asset loans, where they'll have blended rates, especially on 100% financing deals, where they'll finance the 80% over 20 years, but then they'll finance the other 20% over 10 years. Well, the problem is that those initial few years in the business is usually the most strained on the cash flow. So if we can get a longer amortization period, sometimes that's more important than the rate.
Okay. Why are good bankers good problem solvers?
So really with the bankers, there's bankers who can just tell you yes or no, I qualify or not. But often the bankers will have very set, let's call them rules, that they have to, that they have to satisfy internally. Now, just because the deal as it's presented doesn't qualify right now, that doesn't mean the deal can't qualify at all. It just might be, maybe it means the deal has to get done in a separate corporation, where that corporation, for example, they can have first charge over that other corporation. So some bankers, the poor bankers will come back and say, no, it doesn't qualify. But the good bankers will say, it doesn't qualify. But if we were to submit the deal like this, if the numbers were to look like this, we could take another look at it. Now that's a good banker. That's the type of banker that you want to actually be doing, that you want to be, doing business with, because they're going to help you.
Okay. What is a loan underwriter, and how does this limit the authority of your banker?
Yeah, so some people think that their banker has the be-all, end-all say, and they're going to be able to advocate on your behalf, right to the bitter end, and write you the check. The problem is what happens is the person that you deal with internally then submits this deal to an underwriter. Someone in the bank who's purposely cut off from you, that you can't prejudice by selling them on your idea, and they just look at the merits of the deal in its entirety. So the person who this underwriter who makes the final say, you never get to interact with them. And even your banker themselves, they have very limited interaction with them because the banks don't want the underwriters approving loans that are going to be bad just because they're friends. And the banker gets their commission and they're happy, and then the underwriter approves it and the bank's out the money. So even the banks cut off the communication or limit that communication. Out here in Alberta, a lot of times, especially if you're going through a big major bank, the decision is being made once your banker submits it to someone in head office in Toronto, and it's someone that you never speak to and your banker has limited contact with. That's who makes the ultimate decision. So the relationship is one thing, and having a problem solver is another thing, but thinking that it's everything, it's certainly not.
Why should you always pursue more than one lender simultaneously?
So we always have the issues where, earlier on in my career, I would say, hey, we got a banker and they think the chances are favorable. And so we're just going to roll with that. But let's go back to the timelines. It can take, we say 60 days to get a deal approved, and that's kind of the deal. So, and now we have the other factor where the ultimate decision is getting made by an underwriter. And a lot of times there's due diligence that the bank will go through, and they'll think it's a good deal, and then they'll do more due diligence, and they'll say now it's no longer a good deal. That doesn't mean that the loan is not viable. It just means it's not viable at that institution. Now, if you pursued one lender, now you got to start all over again, and that 60-day time clock, it starts all over again. Now, if you're pursuing more than one lender, now all of a sudden you have backup plans. So a lot of deals will just fall apart if you're trying to buy a building or a business, and if you ask for another 60 days, or another 90 days, like that a lot of time that deal is not there anymore. So we like to pursue at least two lenders all the time on any deals that we're doing, and until that check is written, until it funds. And even if we have to pay more than one loan application fee, we're still going to do that, because we're talking it's $500 or $1,000 for a loan application fee when the entire deal falls apart if you don't have the lender.
Are leasing companies a good secondary choice to finance hard assets?
Yeah, they're generally a good secondary choice. They're normally not going to be the same rate as the banks are going to offer. So normally we're looking to get a bank loan first, and then leasing is next. You have to be very careful because there's some lease products out there, 6, 7, 8, 9%, and then there's some lease products out there that are 25%, which are the ones that it's probably the deal breaker that you don't want to go after. So they are a good secondary choice. I would say your primary choice is let's get bank financing first, because it's probably going to be at a lower rate. But if not, leasing can be a very viable alternative. You just have to be very aware and very astute that the lease is the terms that you want, because often the interest rate that they report is not the real interest rate. They might have a financing charge cooked into the deal or something like that. But, so that's what we have here today. Thanks so much for tuning in again. Please hit like and subscribe to continue to get more tips on helping you with your business. And if you have any questions you want answered in future videos, leave them in the comments below. Thanks very much.